All right, guys. So today we will move into more practical content. I'll speak about CTP trade setups today, and I'll provide a few examples from my real-time trading, so you can understand better how I manage the risk and what my favorite trade setups are. When I trade ES or NQ, I often monitor four instruments. There are several approaches, conservative and aggressive. And before I share my approach, let's break them down individually. So one approach can be only entering when equivalent lines are being reached in all of them. Another approach can be three are enough, only entering when equivalent lines are being reached in three of them. It can be ES, NQ, RTY, ES, NQ, and YM, or ES, RTY, and YM. So you understand that the second approach provides you with more opportunities. For instance, ES and NQ and RTY are reaching their resistance level, but YM is somewhere in the middle of the levels. Or YM disagrees, meaning ES, NQ, and RTY are reaching their resistance level, but YM is reaching its support level. In the second case, YM disagrees. In the first case, YM is neutral. In general, there can be three cases: when a correlated asset agrees, neutral, or disagrees. And here is an example. ES is at support, trigger point support. NQ is neutral. YM is also at support. And it looks like RTY broke its support. So ES and YM agree, NQ is neutral, and RTY is at resistance, broke its support, disagrees with ES and YM. Could you anticipate what happened next, guys? RTY went above. RTY followed ES and YM. Now I have a question for you. If you drew a line here, how would I call it? What is this, guys? It's an intraday resistance level equivalent to YM's trigger point resistance. So you may wonder about my approach, whether it's conservative or aggressive. So my approach, guys, balances opportunities and risk. Being too conservative doesn't necessarily guarantee you'll be more profitable, guys. A critical factor in profitability is the risk to reward ratio. And being too conservative can eliminate great opportunities with outstanding risk to reward ratio. Remember that being profitable can be by increasing the number of winners or decreasing the number of losers. Let's say your strategy gives you at least 6-to-1 risk to reward ratio, but only 30% of your trades are winners. Okay, let's take a look at the profitability in this case. So 6-to-1, but 70% are losers. Okay, this means statistically that 3 trades are winners and 7 trades are losers. Let's say that on a winning trade, you make $12K. So this means here you made a 12K, and then you lose 2K, and then you make 12K, loser, 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 winner, loser, loser, loser. So let's take this strategy, these statistics. In total, this means that you make 12, then you lose 2, then you make another 12, then you lose 2, 2, 2, make 12, and lose 2, 2, 2, meaning that in total you are in $22K profit, guys. Now let's replace. Let's say the first trades are losers, and then winner, winner, another loser here, winner, loser, loser, loser. This means you lose 6K in your first 3 trades. Then you win 24, another loser, winner, loser, loser, loser. Again, same, $22K in profit. I just replaced the winners and the loser. But if your account size is only 4K, your account will get blown here. You will not make 22K profit. Your account will get blown beforehand. So the factors you need to consider here is, of course, your account size. So let's say your account size is large, and you can afford a few losers in a row at the beginning. However, the human factor, guys, is also critical, the mentality. So statistically, on small accounts where the number of contracts is limited, there's a high chance of getting payouts, guys. Statistically, in manual trading, the success rate is higher when avoiding over leveraging. So in the previous example, we had a 30% success rate. We found that we do much better when we avoid over leveraging as humans. The probability of FOMOing decreased dramatically once I moved to work on small accounts. In addition, I prefer not to copy trade mentally. It's similar to over leveraging, similar effects. So my approach is trading with small accounts, 1 or 2 minis, even micros in some cases, 2 instruments that I agree can be enough for me in most cases. However, I manage my positions more carefully if there is a correlated asset that disagrees. And I consider exiting my positions if a correlated asset disagrees, like if I'm in a short position on NQ and RTY, if I'm in a short position on NQ and RTY is reaching its support level, I'll probably exit my position or take out half of the contracts I entered with. Guys, if I'm confused in reading the price action, I'm not sure whether ES and NQ agree, this one is below, this one is above. I'm confused, meaning I'm not sure who the leader is. I often look at correlated assets to see what they do relative to their trigger points to make my decision, or I do not take any trades. Guys, don't chase the market. If you're confused, meaning it's not an A+ setup for you, no rush, don't trade. And this leads me to the following topic: how to increase the probability of success. Because we agree that this strategy is very profitable, even with the small accounts, but this strategy means you lose 70% of your trades. So we do want to increase the success rate without risking the high risk to reward ratio opportunities dramatically. Okay, we want a high success rate, at least from the mental perspective, but we don't want to decrease the number of opportunities that provide you with outstanding risk to reward ratio trades. Homework: on a SIM account, measure your success rate when FOMOing, meaning when entering in random places, and compare it to your trades when they were taken according to the plan. Guys, stick to your plan. This is the conclusion. But you're probably waiting to hear my thoughts on how I increase my probability of success, right? I consider statistical measures like the daily ATR, guys. especially in the US session. For instance, let's say ES and NQ are reaching their daily ATR or 80% of their daily ATR. At this point, I will look for reversal points, meaning I look for equivalent lines as reversal points when two correlated instruments are reaching their daily ATR. Another factor is the distance between the trigger points. Homework. Guys, what information do the trigger points reveal ahead of time? And how can you take advantage of it? I'll answer this question in a few slides. So the first question was how I increase my probability of success. The second will be how I increase my risk to reward ratio. And this leads me to the next topic. Now I'm going to present 3 groups of CTP setups. Some of them can be useful for scalping, and some of them for large moves. And then I'll present my favorite setups. The CTP trade setups are divided into 3 groups. The first group is first touch reversals. The second is break setups, breakout or breakdown. And the third one utilizes other EG tools like the EG cumulative delta and EG divergence, for instance. While the first 2 groups are only based on price action reading, pure price action, the third one utilizes additional confirmation tools like divergence or delta. But guys, each of which starts by marking equivalent lines. Every trade setup, every CTP trade starts by marking equivalent lines on correlated instruments. In this group, we have setups where we wait for 2 or 3 or 4 correlated assets to reach their trigger point together, following the first touch rule. You know, the more the line gets visited, the weaker it becomes. And the first touch scenarios have been useful for finding A+ reversal setups, especially when confirmed by a correlated instrument simultaneously. And here are a few examples from my live sessions. You can see the first touch scenarios and the equivalent lines. There's a high probability of reversals, especially when considering 3 instruments. But to increase the probability of success even more, you can consider the daily ATR of them. For instance, when 2 or more correlated instruments reach their daily ATR, you can start to look for reversal opportunities. In the second group, we utilize an equivalent trigger point that has been previously confirmed. For instance, let's say we have equivalent lines here, these support lines. You can see these support lines are equivalent. We have the NQ here and ES here. Then the markets were strongly rejected. There was a resistance line here, trigger point. So we had a support line. Then we could see that the markets strongly rejected off their resistance. In addition, you know, the more the support line gets visited, the weaker it becomes. So we wait for the break of the correlated instrument and take the retest of resistance. Okay, we wait for the break on both. The second instrument is used to confirm the break. We expect them to do it together. And then we take the retest and the continuation to the downside. Guys, this is my favorite setup. when there's enough room underneath for the market to go down. The support line was confirmed here on both. The markets were strongly rejected and bounced off their resistance. It happened also in ES. You cannot see it here. Then the markets got back to their validated support level, equivalent lines. They broke together and a beautiful breakdown candle was observed on both, then retested. And this is a perfect A+ setup for me to take the short trade here. Enough room underneath, support validated, strong rejection of resistance. The market got back. We know that the more the line gets visited and respected, the weaker it becomes. I monitor both of them. I could identify the strong pressure to the downside by looking at the breakdown candle. In most cases, there's a retest here, and I entered a short trade with a very low drawdown here, and enough room for the market to go to the downside. Now, I want to speak how practically I enter my trades in many cases. When I trade setups like the first touch rule on correlated assets, I look for equivalent lines. This is the basic step. And when I trade setups like the first touch rule, these are candidates for me to place my orders. And when I place my orders and stop loss, my timing is also based on what the correlated instruments do. Now, let's take a look at a few examples that demonstrate my timing techniques.